Hi, I'm Lachlan Mackay, Research Analyst on the Montgomery Global team. Since it's the week of Uber's big IPO, I'm going to discuss the wave of unprofitable companies hitting the public markets in 2019. Whilst I'm too young to remember the infamous dotcom bubble, with every high-profile tech IPO, it's becoming easier to draw comparisons between the events of the late 90s and today's tech boom. Uber, Lyft, Airbnb, WeWork, Pinterest, Zoom, Slack, Chewy.com, the list of scheduled 2019 IPOs is long and continues to grow. And after lucrative private funding rounds, easy access to public money has reaffirmed the inordinate valuations of Silicon Valley's favourite VC targets. The oversupply of global liquidity funding these businesses should serve as a warning to any value investor. Investing in unprofitable companies with lofty valuations requires accepting significant risk for potentially adequate returns. Although most have not yet proven they even have the ability to turn a profit, the billions raised in private funding rounds, plus their IPO raises, give many of these companies a long runway as they shoot for profitability. With the current rate of cash burn, these businesses are going to need that time if they hope to stabilize and mature. Uber spent $2 billion more in cash last year than it made in revenue. Lyft expended $980 million. WeWork, which is slated to become 2019's second largest IPO after Uber, last year recorded a net loss of $1.9 billion, which is even more than it made in top-line revenue. Investors will need to be especially patient before expecting to see any returns from these businesses. Any major economic shock could undermine confidence and set off a race to the bottom. Fortunately for the time being, the US economy appears as strong as ever, with a record high stock market, low unemployment, and stable interest rates supported by the Fed. As such, investors have remained unwaveringly positive. The IPO ETF, which adds new public companies to its basket and holds them for 2 years of trading, has climbed 36% this year to an all-time high. Beyond Meat, who produced vegan burger patties, closed its first day of trading last week up 160% from its IPO price, giving the company a $3.8 billion valuation despite its 2018 net loss of $30 million. The business responsible for many of these companies' sky-high valuations is even considering a public offering itself. Masayoshi Son's $100 billion SoftBank Vision Fund is famous for throwing unforeseen amounts at funding tech startups. It is not only the largest Uber shareholder, but also either the biggest or among the biggest shareholders in many of Uber's global competitors, such as Didi Chuxing in China, 99 in Brazil, Ola in India, and even DoorDash, who lead Uber Eats in the US food delivery. Most of SoftBank's investments have not yet realized any returns, so if US rules allowed such a combination of risky bets to list on the public market, it would be a precarious warning sign for the state of the economy. At Montgomery, we have the benefit of both investing in and selling short stocks, which includes this new wave of businesses entering the IPO market. We'll be watching this group carefully for opportunities on both the long and the short side.